Welcome to The Explainer. Today, we're bringing some serious energy to a topic that, well, it might seem highly technical on the surface, but it's actually pure magic once you get the hang of it. We are demystifying the automated balancing engine inside SAP S/4HANA. Yeah, we're talking about document splitting. If you've ever wondered how modern financial systems manage to perfectly balance complex reporting entities automatically, completely behind the scenes, you are absolutely in the right place.
Okay, let's dive into this. Here is our roadmap for today. We'll start with the unbalanced ledger problem, then compare the entry view versus the general ledger view. Next, we'll unpack the three core splitting mechanisms: active, passive, and zero balance. And finally, we'll wrap up by seeing how they all interact in the splitting lifecycle.
Section 1. The unbalanced ledger problem, and exactly why your books simply won't balance in traditional systems. Imagine this typical scenario. You can easily assign an everyday office expense to a specific profit center, right? But things like cumulative tax or vendor payables, they usually just sit there unassigned in a giant pool during data entry. To solve this massive headache, S/4HANA maintains two totally distinct views of the exact same document. First, you have the entry view. This is basically the messy reality of what a user actually types into a transaction, leaving those vendor and tax lines unassigned. But behind the scenes, SAP calculates the general ledger view. It automatically distributes those unassigned lines across the responsible profit centers. The result? Perfect, legally compliant reporting for standards like IFRS or GAAP.
Let's ground this abstract concept with a concrete example. Say you receive an €11,000 invoice. 10,000 is the expense and 1,000 is tax. In the entry view, the user splits the expense, let's say 8,000 to profit center X and 2,000 to profit center Y. Behind the scenes, SAP calculates that ratio. It's an 80 to 20 split. So it takes that unassigned €11,000 vendor liability plus the tax line, and it automatically splits them using that exact 80-20 ratio. Just like that, your debits perfectly equal your credits.
Moving right along to Section 2. Active splitting, or rule-based distribution.
So, think of the SAP engine as a really meticulous detective using a strict rule book. Active splitting is a rule-based mechanism that occurs during primary postings. Think of a fresh invoice coming in. Our SAP detective looks at an incoming vendor line, identifies it as item category 0300, checks the rule book, and sees it absolutely must be split based on the ratios found in category 20,000, which represents expenses. It's a direct cause and effect reaction happening the literal second the document is posted.
Next up, Section 3, passive splitting, known as inheritance-based clearing.
Now, a primary posting is really only the beginning. Passive splitting is an inheritance-based mechanism used for successor transactions that happen later down the line. And this brilliantly illustrates the system's memory. If you pay that €11,000 vendor invoice a week later, you don't need to set up any new active rules. SAP simply looks back at the original referenced invoice, sees that perfect 80-20 split we talked about earlier, and passively inherits it for the bank clearing line. Zero extra configuration required. How great is that?
All right, Section 4, zero balance splitting, which is essentially the internal safeguard.
Zero balance splitting acts as the ultimate safety net for internal accounting. It's a safeguard triggered when individual characteristics, like your profit centers, just do not perfectly balance to zero. When this happens, SAP automatically generates balancing line items using a special zero balance clearing GL account to force a zero balance. Imagine a manual cross-profit center transfer. You move an expense of 5,000 from profit center X over to profit center Y. Well, profit center Y now has a debit but no credit, and profit center X has a credit but no debit. To ensure both entities can produce perfectly balanced financial statements, the system steps in and creates clearing debits and credits literally out of thin air. It forces both profit center X and Y to equal exactly zero.
Section 5, the big picture and our summary matrix.
So the crucial point is understanding how these fit together. Think of this matrix as your high-value cheat sheet for mapping out the core architecture. First, you've got active splitting. That's triggered by predefined rules to handle your fresh primary postings, like invoices. Second, there's passive splitting, which is triggered by referencing a previous document to handle follow-up payments. And third, zero balance splitting. This is triggered when internal balances don't equal zero, acting as your automated safeguard for manual cross-PC adjustments.
Section 6, the splitting lifecycle, where we see the dynamic interaction of these tools.
These rules don't just exist in isolation, they work dynamically on a single transaction. Let's track the life cycle here.
Step 1. A user posts a messy, complex invoice. Instantly, active splitting triggers to split the vendor and tax lines based on the driving expenses. Step 2. In that exact same split second, if the debit and credit amounts of those individual profit centers don't match up perfectly, zero balance splitting kicks in simultaneously to add those balancing lines. So the primary document is saved perfectly balanced. Then, step 3, fast forward to next week when you run the payment. Passive splitting takes over, looking back at the original invoice to inherit the exact profit center ratios for your bank clearing line. It really is one continuous, highly intelligent lifecycle.
Let's shift gears for Section 7, backend configuration and bringing it to life.
Now, all of this incredible automation relies on a global master switch inside the system. In the Activate document splitting screen, a specific method must be assigned. For honestly about 99% of implementations worldwide, consultants rely on standard method 0000012. Yes, 12. It's essentially the brain of our SAP detective, containing all the complex rule mappings for standard business transactions.
Now, what's really interesting here is clarifying a major misconception. Cost centers, WBS elements, and internal orders do not actively split. Remember, document splitting exists to balance the balance sheet fields like profit center and segment. Cost centers are just operational tracking objects, so your manual cost center entries simply feed clues to the system, allowing SAP to automatically derive the correct profit center. And hey, if a derivation fails, constant values act as a fallback. SAP injects a default dummy profit center to ensure the document posts successfully and avoids bringing your business operations to a grinding halt.
As we wrap up this explainer, I want to leave you with a bit of a provocative thought. You've seen how active, passive, and zero balance splitting dynamically and perfectly balance your ledgers based on the operational data entered. So ask yourself, if SAP Splitting Engine is automatically balancing your books behind the scenes, are your manual cost center entries and how your master data is maintained helping or hindering the detective? Remember, the automation is really only as good as the clues you give it. Keep exploring your system configurations, stay curious, and we'll see you in the next explainer.